Here's how to give your house to your kids while you're alive, continue to live in it, and get a huge tax break for everybody. Everybody, I'm Christopher Small. I'm the owner of CMS Law Firm. We do estate planning, we do probate, we do well. I'm going to run through this real quickly. There's going to be a longer video that I'm going to make that kind of gets into the details. You need to go to my YouTube channel if you want that, okay? I don't know where you're watching this. Just search for CMS Law Firm on YouTube and subscribe. Okay, so here's how it works. You have your personal residence. You are going to sell it to your kids or your child, whichever one. Because it's your personal residence, when you sell it, you're going to get up to $250,000 of capital gains tax exemption. If you're married, it's $500K. If you're over that, then yes, you are going to pay some taxes, okay? The sales agreement is going to be for a very long term at a very good interest rate, okay? You're going to calculate what that payment is. Your kids are actually going to pay you that money every month, like it's a mortgage, okay? Once that transaction is complete, you are then going to rent the house back from them, okay? And no, you're not going to rent it back for exactly the amount of the mortgage payment. You're going to figure out what the fair market value of the rent is, and you're going to pay that. They're usually going to be pretty close to each other, okay? So that's step one. You get the tax exemption, so no tax for you. The money is going to kind of wash, right? You're going to pay them in rent. They're going to pay you for the house. Here's where the cool part is. Now that it is a rental for the kids, they can depreciate that home over time. They can even do accelerated depreciation if they want and reduce the taxes. They also get to write off the maintenance. They get to write off the property taxes. They get to write off the interest. They get to write off all that stuff. And when they come visit you once a year to check on the property, it's also a business expense that they can write off. So it's a win-win-win-win-win. Think about it. If you're wanting to get rid of your real estate, you don't have to worry about the step up in basis. And that asset is now out of your estate when it comes to estate tax purposes. So hope this helped. If it did, that's great. Don't forget to subscribe, like, comment. If you have questions, let's go.